Hello, everyone, and welcome back to this week's Financial Forensics Briefing, where we break down the most relevant developments in fraud, financial crime, and investigative intelligence. I'm John Luca, and this is your weekly update from OSINTinvestigate.com. Let's dive into the key stories shaping the financial forensics landscape between March 23rd and March 29th, 2026. We begin in the United Kingdom, where regulators are preparing for what could become one of the largest consumer redress cases in recent financial history. The Financial Conduct Authority is set to unveil a compensation scheme tied to the mis-selling of motor finance products. At the core of the investigation are commission structures between lenders and car dealerships that may have inflated borrowing costs for millions of consumers. Estimates suggest compensation could reach up to £11 billion. From a forensic standpoint, this case highlights the increasing importance of transaction transparency and the reconstruction of historical financial flows, particularly where incentive structures distort pricing models. It also underscores how regulatory data analysis is evolving into large-scale forensic reconstruction exercises. Next, we turn to a major fraud trial unfolding in Abu Dhabi, involving the collapse of NMC Health. The $5.4 billion case against founder BR Shetty centers on allegations of hidden debt, falsified financial statements, and systemic misrepresentation of the company's financial position. Investigators previously uncovered over $6 billion in undisclosed liabilities. This case remains a textbook example of forensic accounting failures at multiple levels: internal controls, audit oversight, and cross-border financial reporting. It also reinforces a recurring theme in financial forensics. Fraud at scale is rarely a single-point failure, but rather a network of coordinated misstatements. Another major development this week comes from the private credit sector, where stress signals are raising concerns among analysts and investigators alike. Several large asset managers, including Apollo, KKR, and BlackRock, have imposed restrictions on investor withdrawals amid liquidity pressures. Meanwhile, credit downgrades and valuation concerns are emerging across portfolios, particularly in tech-linked lending. From a financial forensics perspective, this environment creates fertile ground for risk concealment, delayed loss recognition, and aggressive valuation practices. Historically, periods of liquidity stress tend to expose underlying irregularities, making this a space investigators will be watching closely in the coming months. Meanwhile, broader data continues to confirm a worrying trend. Financial crime is accelerating at scale. Recent industry analysis estimates that illicit financial activity has now reached approximately $4.4 trillion annually, with fraud losses alone exceeding $500 billion. A key driver is the growing use of artificial intelligence by criminal networks, enabling highly sophisticated scams and automated social engineering campaigns. For investigators, this marks a structural shift. Financial forensics is no longer just about tracing money. It's about understanding hybrid threats that combine technology, psychology, and global financial infrastructure. Finally, a notable case from India highlights the continued relevance of traditional fraud techniques. Authorities are investigating a multi-million-dollar bank fraud involving fake fixed deposit receipts and hundreds of unauthorized transactions linked to municipal accounts. Even in an era of AI-driven crime, this case reminds us that document fraud, insider manipulation, and basic control failures remain critical vulnerabilities, especially when combined. So what are the key takeaways this week? First, financial forensics is becoming increasingly systemic, with investigations spanning entire industries rather than isolated entities. Second, the integration of AI, both by criminals and investigators, is redefining the tools and timelines of financial crime. And third, despite technological advances, many fraud schemes still exploit fundamental weaknesses in governance, oversight, and human behavior. That's all for this week's briefing. If you found this useful, you can explore more insights, tools, and investigations at OSINTinvestigate.com. I'm John Luca, and I'll see you next week with more updates from the world of financial forensics. Stay informed and stay vigilant.